When uranium markets begin to tighten, attention inevitably shifts towards new projects. If supply is constrained and prices are rising, the natural assumption is that development will solve the problem. New mines will be built, new pounds will arrive, balance will be restored. That assumption feels reasonable. It's also where many investors misinterpret how the market actually works. In this video, I'm going to outline 4 reasons why replacement, not production, is the real constraint in uranium. Together, these points explain why development assets are being repriced, why scarcity can persist even if projects succeed, and why replacement value matters long before replacement supply exists. The first point is this: replacement must arrive on time, not just exist. In uranium, supply only matters if it enters the market within the window that governs utility contracting. Utilities do not buy uranium based on what might exist someday. They contract fuel years in advance based on what they can rely on for delivery. Supply that arrives outside that window does not relieve pressure. It arrives in a market that's already adjusted. Many development projects are described in terms of size, resource quality, and eventual production potential. What is often missing is firm, credible delivery timing. A project that enters production later in the decade may be valuable in an absolute sense, but it does not prevent near-term scarcity. It does not change contracting behavior today, and it does not cap prices during the period when utilities are competing for coverage. For investors, the key takeaway is simple. Replacement that arrives late does not function as replacement in the market that sets price. Point number 2 refers to scale. Most projects are too small to offset what is being lost. Uranium supply does not stand still while projects are being developed. Existing mines decline over time due to depletion, recovery loss, and operating constraints. Replacement must therefore do more than add supply. It must first replace what's already disappearing. Many development projects are meaningful on a standalone basis, but small relative to system-wide decline. Even when projects succeed, they often arrive in increments that slow the rate of contraction rather than reverse it. This creates a structural outcome where new supply improves the slope, but not the balance. Scarcity persists even as projects come online. For investors, this explains why successful development does not necessarily resolve tightness. The math does not require failure, it only requires insufficiency. The third point is this: replacement absorbs capital long before it delivers supply. Development projects change market psychology well before they change physical supply. As projects advance, they absorb capital, management attention, skilled labor, and political focus. They signal intent. They raise expectations. But they do not immediately add pounds to the market. During this long interval, the system remains dependent on a shrinking operating base. Utilities cannot contract future supply that has not yet cleared permitting, financing, construction, and commissioning. This creates a gap where replacement is visible but ineffective. That gap is precisely where development leverage emerges for investors. Markets are not pricing near-term production. They're pricing future control over scarce replacement options. The final point is this: replacement changes who matters, not whether scarcity exists. Replacement supply rarely arrives in sufficient quantity, speed, or coordination to restore balance. What it does change is which assets the system will depend on next. An existing production depletes, future supply becomes increasingly concentrated in the hands of the next generation of projects. That concentration gives development assets strategic importance long before they produce uranium. Replacement does not end scarcity. It reshapes it. The market begins to assign value not just to current pounds, but to future control over supply pathways. This is why development leverage emerges even while physical tightness persists. To bring this together, replacement is the real constraint in uranium for 4 reasons. It must arrive on time to matter. Most projects are too small to offset ongoing decline. Replacement absorbs capital long before it delivers supply, and successful projects change dependency, not abundance. For investors, the key adjustment is this: don't confuse successful projects with solved scarcity. Replacement determines who the market will rely on next. It does not remove the constraint that forced the market to reprice in the first place. That distinction explains why development assets are being repriced now, and why this phase of the uranium market feels structurally different from past cycles.